Hi friends, welcome to my YouTube channel. On today's agenda, we will be delving into a very crucial financial concept that everyone should be aware of. That is time value of money. This encompasses three main elements: future value, present value, and net present value. Now, once you understand these concepts, you will be able to analyze any financial instrument or financial offering, whether it is an SIP, an investment plan, or even the cash flow of a company. So let's dive in. The first thing that we need to know is what is time value of money. The value of a dollar today is more than the value of a dollar tomorrow. Why is it so? There are various reasons. Two main reasons are interest rates and inflation. Let us imagine the price of rice grains in the market today is 100 rupees or dollars per kg. After 1 year, the price of rice grains becomes 200 rupees for a kg. So 100 rupees will be able to buy 500 grams after 1 year. This is known as inflation. And hence, time value of money becomes very important to understand any financial instrument. Getting into the formula, future value of money is equal to present value multiplied by 1 plus r raised to the power of n, where r is the rate of interest and n is the number of years. This happens because of compounding. We will discuss compounding in details in another video. From this equation, if we want to derive what is present value is future value divided by 1 plus rate of interest raised to the power n. We will try to understand the concept of future value. In case 1, suppose I invest 5,000 rupees or dollars in year 1. Now, if the rate of interest in the market is 10%, after 5 years, how much should I expect? I should expect the future value of this 5,000 rupees or dollars. How to calculate that? Equal to FV, opening bracket, rate multiplied by NPER is the period. So period is 5. PMT is considered when there is a series of payments. We will look at the second example. Here, we do not have a series of payments. We only have one payment. So it is going to be 0. The present value for which we are calculating the future value is 5,000. Because it's a outflow, we will put negative here, comma. Now, 0 says at the end of the period. So interest will be paid at the end of the period. So when you are putting the money in a bank, interest is paid at the end of the year. This is what it says, end of the period. 1 means beginning of the period. Usually we will consider 0, which is at the end of the period. And the value comes 8,052. This means that if I invest 5,000 rupees today, after 5 years, considering rate of interest, inflation, and other things at 10%, I should expect 8,052 at the end of 5 years. This concept has a lot of applications, very practical applications. Number 1 is when you are going for any investment. You are investing a certain amount of money in SIP or in a bank. You can use this formula to understand after a certain period of time how much you should expect. Also, in case you are doing a retirement planning, this has a huge importance. Suppose your monthly expense today is 20,000. And you want to understand when you retire, that might be after 20 years, what this amount is going to be. It comes to 1,34,550. This means that when you retire, your expenses per month will become 1,34,550. Similarly, you can take all your expenses, your medical expenses per month or per year, your food expenses, everything, and you can try to understand when you retire, what is the minimum amount that you should expect as a retirement corpus. I will come to the next example. The next example is applicable for cases like a SIP or any financial instrument where there is a series of payments. So you start an SIP with maybe a certain amount of money. Let us consider 1,000 rupees or dollars. Every year you are paying this amount of money. You are paying this for 5 years. So what is the future value you should calculate for this? The formula remains the same, equal to FV, opening bracket, rate is 10%. Then we have our number of periods. We are considering for 5 years. Payments. Payments is, this is my monthly payment minus 1,000. There is no present value. We are doing it for a series of payments, and obviously 0, which is interest at the end of the month. This comes to 6,105. So if I am going for a SIP or any instrument where there is a uniform outflow for a certain period of time, at the end of the period at a 10% interest, I can expect 6,105 of payment. So the formula for future value is rate, comma, period, comma, PMT in case of a series of payments. Otherwise, the present value, and 0 if the interest is at the end of the month. Now I will move to present value. For the first case, I have a cash outflow of 5,000 in year 0, which is at the present. And then we have a series of future cash flows, and at the year 5, I receive 5,000 back. Is it a good business proposition? For that, I have to bring all the future cash flows to the present and then compare. For that, in Excel, we have the formula called NPV. How do we do that? Equal to NPV, opening bracket, rate, comma, I have my series of values, and I close bracket, and then I subtract the initial amount. It comes to negative 1,895. That means the series of payments in the present value is less than what is my current outflow, and hence it is negative and not a good business idea. What I see is there is an outflow of 5,000 in the year 0 or at present, and there is a series of future cash inflows, which is 1,200 per year. So if I sum it up, it is 6,000, and on a cash to cash basis, it seems like it is a good business proposition. My outflow is 5,000 and my inflow is 6,000. But let us use NPV with a discount of 10% to see if it is a good business deal. Equal to NPV, opening bracket, 10%, comma, my series of inflows, close bracket, then I subtract my, what we see is it is negative. That means considering a discount rate of 10%, the value of my future cash flows of 1,200 per year for next 5 years today is less than even 5,000. Hence, it is not a good business deal. Let us try to calculate what is the present value of the future cash flows equal to PV opening bracket rate 10%, and I have to fix it, followed by number of periods. This is my number of period. Payment, it is 0, comma, fixed value is this one, comma, 0. Now, if I drag this to the right, this is 4548.94. And what is the difference? This one, it is 451.06, right? This is my net present value, my present value and the net of all future cash flows. Now I have the third case where there is a series of cash flows, but which are not equally distributed on the time horizon, and the cash flows are also uneven. How do we calculate the NPV here? For that, there is a function in Excel called XNPV. Let us use that. Equal to XNPV, opening bracket, the rate, comma, the values, comma, the dates. This is one of my most favorite functions. And I get the NPV, which is negative, and I understand this is not a good business proposition, and I can always check my business plans once again. The NPV formula is rate, series of cash flows, and the date range. With these three functions, I feel that you will be in a position to verify any business proposition, any financial instrument, and can take a prudent decision. If you have liked the video, give it a thumbs up and please subscribe to this channel. In case you want to see more such videos, write to me. I will create more of this type of videos which will be of your help. Thank you.